Hi everybody, my name is Sean Scudolaro. I'm a Senior Tax Manager at Cohn Resnick, working down in the Eatontown office. I handle all types of tax. Had previously worked at a smaller firm, so really we did pretty much everything we can get our hands on. So I've got a good background, been working in 10 years in tax departments, and am now also the chair of the Federal Tax Committee for the NJCPA. We meet 6 to 8 times a year, either in Roseland or Metro Park, and honestly, what I'm about to give you today looks a lot like what we had at our meeting yesterday down in Metro Park. So anybody who was at that, a lot of this will be familiar. But if you're interested in joining the group, you could always contact me about that. But that's a little bit about myself, so we can get going. All right. So what am I going to talk about today? Just a few slides that if you have these, they'll just kind of be guides for you. We won't spend too long on them with the IRS inflation adjustments that happen every year. Then we'll spend some time talking about the tax extenders, where things stand, where we expect them to go, and just a reminder of all those provisions that are out there hanging around that we always have to wait until either December 15th, maybe even January, to get retroactively extended. Then we'll also kind of go back and review the 2015 tax season changes, and what that means is really kind of just take a look at those TPR regulations that came out, all the material and supply rules and capitalization rules that we now have spelled out for us in those regulations. It really was such a big and sweeping change that I think it does make sense to go back and just take a look at that again and revisit some of the key terms. And then changes for 2016 and beyond. There were a few changes over the summer in some bills that were passed that slipped through. Some of them don't really come into effect until 2017 rather than 16, but we'll try to address everything that came up this year. And then 2 more points before I get going. This is my first webinar, so the last thing I want to do is fool around with the chat box in the bottom left corner of my screen while I'm trying to give this. So what I'm going to do is we're going to collect a lot of those questions that you guys have and send on through, and we're going to kind of address them all at the end, and then kind of pull up the ones, and whatever we have time for, we will try to get to. And then, as I said earlier, this is my first webinar, so we'll be going on this trip together. So you have any complaints, I'm sure I'll read them loud and clear afterwards, but hopefully we get through this without too many hiccups. All right, and here are some of the more common inflation adjustments, just general ones. You'll see now that top tax rate is tied to inflation every year, as well as the standard deduction, the P's limitations, and thankfully that AMT exemption, that was one thing that did get made permanent, is now we don't have to have an extra column in our projections at the end of every year. That is going up again, and we don't have to worry about that being tied to the extenders. So the foreign earned income exclusion, as well as the estate and gift tax going up again as well. Or excuse me, the unified credit amount, not the annual gift exclusion, will go up. And here, what everybody looks for, the mileage rates. You can see the business mileage rate went up a tick, even though gas prices didn't go up too much. I wouldn't be surprised to see it stable again this year when they're announced. They're usually announced in the middle of December, so that's why we don't quite have the 16 numbers yet. But 15's in the books, and those are the numbers. Medical moving rate actually did go down a half a cent, and charitable has been stable for a while now, so that's still at 14 cents a mile. And then here's some other ones I thought I'd throw out there, the kind of the defined contribution plan inflation adjustments. There'll be some changes in 15, and the 16 ones have already been announced, and not much is going to change between 15 and 16. But just some numbers to keep in mind as we're now in that tax planning season, tax planning mode. Things to keep in mind. The IRA phase out is changing. The 401k max compensation is changing if you're doing any planning around that. The deferral amount and the catch-up amount has changed for 15 from 14. So just keep an eye out on that as you're going through with your clients towards the end of the year and making those tax planning moves. Okay, so now we'll get into a little bit more of the meat. Those hanging tax extenders that we talk about every year. As you remember last year, 2014, bill was sent to the White House on December 16th. And from everything we're hearing, that's probably what we can expect again this year. Congress is not generally interested in hanging around over the Christmas break and letting it go down into the new year. So we'll probably get something in the middle of December, and hopefully, there is something that came out of the Senate Finance Committee already that's pretty much what we expect to see, which is a 2-year extension. I'll talk a little bit about that later. That hopefully will come through. So, as long as that's where we end up, there shouldn't be too much work to get done to get it through the House and the Senate. But everything did expire on December 31st, 2014, and what we're really hoping for is that 2-year extension. So rather than having 16 days to plan on it like we did last year, we'll have 1 year and 16 days to work with a tax code that's reliable. What are the expectations? That's kind of where we are. Is that it should be a 2-year window we're given, so it bypasses the election season next year. And we're stuck again. How do we plan for our clients? All I can say is those either those B&A projections or whatever projection software you're using, it's probably going to have a bunch of columns because there are just a lot of variables out there. I'd be shocked if they didn't get passed. You could probably go on the fact that they will, but it certainly leaves us out there. So what are those extenders again for individuals? The above-the-line $250 deduction for elementary and secondary school teachers, the exclusion of the discharge of qualified principal residence indebtedness. I know I was at an economic summit earlier this week, which spoke about New Jersey having the highest rate in the country of severely past due mortgages over 90 days. So certainly people in New Jersey are probably interested in that being extended. The mortgage insurance premium deduction, something that doesn't hit us, the sales tax, the additional kind of income limit and years for the conservation property, qualified tuition, and something that's been brought up to me already a number of times, the tax-free exclusion of the charitable IRA distributions. I know if you want to get something done out of an IRA, it takes more than 5 days to do it. So it would be nice if they give that to us a little bit sooner. And as I said, the one thing we can all be happy about is, we're not waiting on that AMT exemption being tied back to inflation. That is permanent, so we don't have to worry about that. What are some business extenders? The low-income housing provisions, the credits, and then, just to remind everybody how far-reaching these credits are, they get extended every year. We have these Indian employment credits, railroad track maintenance credits, things that don't come up much, but have been around forever, and now we have to wait every year to make sure they get passed, as well as the work opportunity credit and some film and television production cost expenses. So what are the more popular ones, right? I think we're all well aware of them by now, but the accelerated depreciation methods, and in particular, that 15-year straight-line cost recovery for the leasehold improvements, the restaurant and building improvements, the retail improvements, and the bonus for first-year depreciation of 20-year life or less. And I can't tell you how many clients are eagerly awaiting that, both on the seller side, waiting to see if they're going to have customers coming in buying, as well as clients who are wondering, hey, can we get that equipment? What's the tax ramifications going to be before the end of the year? Is it going to make sense for us to do it? So again, 15 days, it's not ideal, but that's probably what we're looking at again to try and deal with this extender at the end of the year. And then also, in addition to the bonus depreciation, the increased 179 limits. And currently, as enacted law stands, you can take 179 on 25,000 of equipment, and that will start to phase out dollar for dollar at 200,000 of equipment purchased, and that's you got to watch out for controlled groups there as well. But at 13 and 14 levels, we know we're 500,000 of equipment and up to 2 million of equipment total purchased with the dollar for dollar phase out starting there. So that really would make a huge difference to get that through. And then one of the other ones, the built-in gains tax. I got a lot of clients, or one in particular, who has been kind of stuck where they're now past that 5-year mark, but they don't know what to do because they're in between the 5 years and the 10 years. So, they couldn't do anything this year, but they're dying to sell some assets in an S corp that have some built-in gains tax attached to it. And all I can tell them is to, sit tight for a little while, and hopefully we'll get there. Hopefully we can work, in 16. Because certainly if you're trying to sell an asset, 15 days is generally not enough time to do it. So that, it's gone from 7 years, 10 years, 5 years over the course of the last, 7 years. But currently it's at 10 years, and hopefully it gets knocked back down to 5. And the other thing is the qualified small business stock. This exclusion relates to C corporations. It's on the first 10 million. There are some limitations to it, but if you're doing some planning with clients and they say, hey, we're starting up a business. We're hoping for an exit strategy in 5 to 10 years, because you do have to hold the stock for 5 years before you get these benefits. Should I start as an LLC? Should I start and be taxed as a partnership, an S corp, a C corp? Knowing that you'll have this 100% exclusion as opposed to the 50% exclusion, it certainly does help to kind of understand where things stand and be able to tell our clients what they're looking at down the road. But that's also one of the other items hanging out there. So what's next, and kind of where do we stand on a legislative sort of point right now with this? Well, in July of 15, as I mentioned earlier, the Senate approved a 2-year extension of most of these extenders retroactive to, or I believe all of them, retroactive to January 1st, 2015. That would take us through December 31st, 2016. Right, and the problem here that's been holding things up has been a little bit ideological, as you can imagine, Republicans and Democrats not seeing eye to eye. The way the House has been trying to go about it has been to add certain provisions inside the extenders and trying to make them permanent and putting them inside other bills. So you've seen things like the conservation property and the additional benefits for contributing that. You've seen that show up and been tried to make permanent. And everything is stalling because the House is trying to make things permanent. The Senate is trying to keep extending and is of the mind to keep extending things. And you can see even there in an interview recently, the new chair of the House Ways and Means Committee, who took over for Paul Ryan, Kevin Brady, he's already stated that he's trying to make those extenders permanent. So you can see that gap still exists of the Senate's way of dealing with it by continuing to have these extensions while the House is of a mind to make a lot of these permanent. And honestly, I think there's some legislation out there right now that is looking to make at least the bonus depreciation permanent, and I think there is a lot of push on both sides to at least go there and get that 50% bonus depreciation through. So I wouldn't be surprised if we see that. However, there are a lot of extenders in there that we're waiting on. So whether or not they all come through and are made permanent, that's probably a tall order, given that it's going to have to be revenue neutral. So we will see, but in a month, I'm sure we'll have at least a little more clarity on 15 and hopefully 16. All right, with that, it looks like we've come to our first polling question. So everybody can kind of give their responses, and we'll close the poll in a bit once I've seen that most of the attendees have given it an answer. All right, looks like I think pretty much everybody has responded. So I'm going to give it about 5-10 more seconds, and then I will close it out. Cool. All right, great. A good even mix today. That's good to see. All right, so as I mentioned, Now we're going to dive back into a little bit of the tangible property regulations that were given that became effective in 2014. For those of you in private, hopefully you've started to take note of these, and because a lot of the provisions in here require that for book purposes and tax purposes that you're keeping consistent. So hopefully your tax advisors, your CPAs have kind of brought you up to speed on this, and now everything is in line. And for the CPAs in public practice, hopefully you reached out to your clients in January, February of last year, made sure they had their accounting policies in place, the document in place, and got everything up to speed. But we'll take a look at all this quickly again and just make sure we hit the key points. So this is just kind of a review of how we got there. It was something that was on the IRS's docket to clarify a lot of these rules for a very long time. So, and as you can see, proposed regulations were sent in, withdrawn, and then we finally got to where we were. And I think there were a lot of good things in this provision, including some of the safe harbors that are in there. Certainly, there were plenty of CPAs clamoring that these needed to be higher numbers, that 500 without an applicable financial statement still wasn't high enough. But honestly, something clear-cut, I think, is better than nothing. Where we got to was still a step in the right direction, even if it wasn't an ideal world. So the material supply deduction, right? This looked to define, what can we deduct when it was paid and what can we deduct when used or consumed, right? So it really had a matter of what's tangible non-inventory property, right? It's used, maintain, repair, or improve tangible property, fuel, lubricant, water, used within 12 months, has an economic useful life of 12 months or less, or costs less than $200, right, the invoice item. So in those instances, we're going to be able to deduct what we need to deduct. We're going to, there's going to be safe harbors that we fall under, and hopefully everybody was able to utilize these in 2014 and going forward. Right. So, and as I stated here, you don't need to have an applicable financial statement to take advantage of these rules. However, whatever you're doing on your financial statement has to reflect what's going on in your tax return. So you can't have these big book tax differences to take advantage of these new safe harbors. Right, and the tangible property costing $200 or less, right? So, and again, we go back to that invoice rule. So if you've got cell phones, you buy 200 cell phones at the same time. So your bill, and those cell phones cost $100 each. You're looking at $20,000. However, the invoice, every item was less than that number. So now we can write off all those cell phones right away, right? And so that's one thing we want to be able to take advantage of. Okay, deducting repairs versus depreciating improvements. Right, and so that gets back to the heart of, really trying to define what is a repair versus what is a capital expenditure. And, if you've ever got a weekend to kill, you're sitting on a beach and you've got nothing better to do than pore over some regulations. These new 263A 263 regulations, there are so many specific examples within these repair regulations that really you can, if you have a scenario, there's a good chance that something similar to what your scenario is going to be covered by a lot of these specific examples in the regulations. So I do suggest you take a look if you've got some time. Right, and what's a capital expenditure? You're buying a new building, a new piece of property, a new tangible item. Or are you making a permanent improvement or betterment, or are you restoring it significantly? Right, so that's kind of what we're looking for there when we're thinking about the difference between a repair and a capital expenditure. And so you capitalize cost to buy and sell real or personal property. So, and the interesting thing about these regulations were they went into a lot of detail about real property, about land and buildings, and even, as we'll see later, setting up what the separate units of property are for a building. But for other types of property, they really didn't get down into too many details as far as units of property go. So it does leave you with a lot of leeway if you're dealing with something other than a building. So what are those exceptions we were talking about? Kind of hit those de minimis relief amounts, right? If you have an applicable financial statement, and what that is going to be an audit. It's not going to be a review or a compilation. An SEC, anything you're filing with the SEC or anything you're filing with a government agency, right? They're going to take that as an applicable financial statement. So you're going to be able to write off anything with an invoice price of up to $5,000. And so what are the catches there? As I mentioned earlier, you've got to have a written policy in place technically at the beginning of the year if that's what you're going to follow and that's what you're going to do, and you're going to fall under this safe harbor. And then what's the other thing? You've got to make sure that your books are in line with the tax policy. So you can't be capitalizing things for book purposes to make your financial statement income look good, and then taking those deductions from the tax return to pay as little tax as possible. Right, and you always still have that material and supply relief. However, if you're going to take this safe harbor, that $500 is, even if you don't have an applicable financial statement, all your materials and supplies are going to fall under that. Another thing to think about is when they say invoice costs, when you have installation charges, things like that, which are spread out amongst a lot of items, there are instances where you're going to have to prorate that amount to the different items on the invoice. So something to keep in mind when you're trying to determine, okay, do I fall under the 500, the 5,000, or is it over that number? And then another thing to think about, the de minimis election. It is an annual formal election, so it was on pretty much all of my, all the tax returns that went through me last year, and it's going to have to be there again. It's not like a rental real estate election where you make it once to group, and then you're going to, that same grouping, as long as nothing changes, you're not adding different activities, that's there forever. You're going to have to make it every year. It has to be on a timely filed return, so if your return's late, maybe you don't owe tax, maybe you're not worried about penalties and interest, but you're going to lose the benefits of this de minimis provision. Then it is irrevocable. You can't go back and decide that, well, maybe it would have been better if I spread those items out. I was capitalizing, and it was my book policy to capitalize some of these lower cost items and bring them forward to a future year. You're not going to be able to go back and do that. And the other thing to keep in mind is that these are just safe harbors. It's not the IRS telling you you can't deduct something, where you can't have a written policy in place where you deduct everything over a certain number. What they're telling you is, yes, we're not even going to fight you. We're going to, you put that election on your return, and 500's the number, and we're not going to worry about anything under that should we question this. However, if your business purpose, if your dollars are so high, or you have a reasonable case to make that you should be deducting everything over $750, everything over $1,000, and you don't have an applicable financial statement, well, then certainly you can do that. You're just going to have to document it, and you're going to have to prove to the IRS that for your business this makes sense. So something to keep in mind. Right, and I talked about this already. What is an applicable financial statement filed with the SEC, audited by a CPA, or provided to any federal or state agency other than the IRS. Right. So we got into this earlier, but an improvement or a betterment, we must capitalize that to the unit of property improved if it results in a betterment, restores it, or certainly if it adapts it to a new use. Right. In the classic example there, something that's in the regulations, you have the machines on the factory line. If you rearrange them to produce a new item, then that's something you're going to have to capitalize. So what is a unit of property? All components functionally interdependent comprise a single unit of property. So, the house is not going to work, right? The most famous example of this, is that the house is not going to work without the HVAC system, right? So that's why when we replace that, we've got to use that same kind of life. So when we replace that, it's that 39-year class life if we're talking about commercial, or it's the 27 and a half if it's residential. So that was really what's set up here. Right, they're all dependent on the other. They're a network of assets. So that's something we got to think of, and they're the special rules for the buildings, right? And so here we are, the building units of property, the building systems, right? The HVAC and ventilation, the plumbing and electrical, the escalators and elevators, the alarm systems, the gas distribution systems, right? And like I said, what if it's not a building? And I've had these conversations, and I've been in a number of CPE where you have CPAs who either want to be conservative or aggressive on this notion of what is a unit of property. And depending on how big or how small you determine your unit of property is, really may determine how many times you can, when something is completely replaced. For instance, if you have large vehicles, right, construction equipment, and you're going to keep the shell of that piece of construction equipment for a long time. When you have to replace that engine, is that engine the unit of property, and are you replacing it and now have to capitalize something, or is is it the entire car, and are you just making a repair and a replacement, and you're expecting to do this, which we'll get into, more than twice in 10 years, more than twice over the life of the asset. So you're considering that a repair. It's certainly something to think about, talk to your client about as you discuss their repair and maintenance line items before year end, or even as you're doing the tax return next year. Right, and so then what are some of the other safe harbors we were given? There was also a small taxpayer safe harbor given. Right, if you have less than $10,000 of costs, or 2% of the building's unadjusted basis, if your total of improvements and repair and maintenance falls under that number, then the IRS is going to allow you to make an election to deduct all those items, right? Once you go over that amount, you can't. You lose that small taxpayer ability once you go over the $10,000. What is a small taxpayer, right? Is sort of that same average gross receipts test of 3-year average receipts less than or equal to $10 million, and then the eligible property has a $1 million maximum unadjusted basis. Right, and then this was the big issue that came down, not necessarily, poring over and understanding the regulations, which I think, certainly in our federal tax group, we had speakers come in a couple of times during 2014 to try and get up to speed on what was really going on and what the changes were. So I think everybody was okay with that, but then what got everybody in an uproar was really the compliance that the IRS was trying to push on you, or push on everybody by the beginning of 2015, end of 2014. It became very apparent that the IRS was leaning towards requiring every single taxpayer that had a business which had some kind of materials, supplies, or tangible property to file a 3115 to adjust their books to reflect this. And it's strange when the IRS changes the rule. They generally expect you to adhere to that rule on a prospective basis and take care of it from there going forward. But with this, they really wanted everybody to go look back to every year and see what they should or shouldn't have done, and pull that through in a 3115 last year. And there were a number of new changes added to the form. I kind of listed a few of the common ones there that wound up on almost all the 3115s that we had to do regarding material supplies, and and the unit of property rules, right? But luckily, there was enough lobbying by the AICPA, but I'm sure all the state society groups, the CPA profession saying, one, we don't have the time to do this work. Two, our clients certainly don't want to pay us to do it. And three, you're going to make us send all these paper 3115s to Ogden, and they're going to sit there and nobody's going to look at them. So we don't understand why we really have to do all this. And then in February they did kind of acquiesce to that and provide some simplified procedures for small taxpayers and what kind of those normal limits of under $10 million of average annual receipts for the prior 3 years, or under $10 million of assets. If you fit into one of those categories, you were going to be able to avoid filing the 3115. And that revenue procedure sent out 2015-20 gave the exactly what you had to put with your return to sort of adopt that under the simplified method, right? And we had a lot of education at our firm about what does that mean though, right? Okay, our jobs are easier and we can get our returns out finally, but what conversation hopefully did you have with your client about that? And the answer is, the 3115 was supposed to provide a level of audit protection where if you go back and you make those changes, right now you're limiting your audit exposure should the IRS decide that you had something that should have been done back in 2012, repairs that should have been capitalized under these new rules in 12. Because of that 3115 you filed, you've now consolidated those changes into the 2014 tax year. And you've gained a little bit of protection as far as where the IRS can go to try and get any penalties, interest for something you may have missed as you hopefully asked your clients to review their files or reviewed for them to make sure everything was in line with these repair regulations. Whereas if you didn't do that 3115, if you adopted these simplified procedures, the IRS now says that they're open to go back to those older years if they find it, and now those adjustments are going to be in those older years, not in the 14 year. So it was certainly something to we made sure we at least had that conversation with all of our clients who we did the simplified procedures for. It was a lot better than having to do a 3115 for them, but it was you still had to have the conversation, educate the client about what was going on, and certainly, right, for all the CPAs here in public practice, right, I know when we have a new prospective client coming in, the first thing we're doing is looking at last year's return and making sure there was nothing missed. I'm sure this is going to be one of the first things that we look for every time. Every time this year I get a 2014 return to review to try and do a budget for a prospective client and see what the cost is going to be and what may or may not have been missed on last year's return, what we can do differently, checking to see that A, either the 3115 is there, or B, the statement under Revenue Procedure 2015-20 is there, electing this small taxpayer procedure, right? Because what happens, if you want to file a 3115 now to change to one of these methods, and it's not an automatic change like it was in 14, they're going to want that $7,000 user fee to submit the 3115. So it's definitely something to be aware of, and I'm sure if you were coming to our group meetings, like I said, you were aware of it, but it's still worth revisiting here. All right, now on to 2015, and we'll try to attack some of this. Most of it happened over the summer, but there are some significant changes other than the ACA, which we will kind of go over towards the end here. So there was a highway funding bill, HR 3236, which addressed a number of due date changes. My personal favorite, because I do a lot of tax returns for either foreign individuals or U.S. expatriates, was the FBAR filing change, which is beginning in calendar year 16. Now, instead of having that June 30th deadline with no additional extensions, we're talking about an April 15th deadline with a 6-month extension, pretty much mirroring the tax return. No more chasing my clients down in the middle of the summer as they're off who knows where, or they're back in their home country, visiting family, trying to get them to print out a piece of paper, take a picture of it with their phone, which is now the preferred method of sending back an e-file authorization form for a lot of my clients, and hunting them down. I only have to do that once now, and there should just be an extra form in there, which I'm very happy about. Another change will be the C corporation returns, which does make a lot of sense in a lot of ways. Now you're going to move those pass-through entities up, the partnership, up to that 3/15, 9/15 deadline, and the C corporation is going to be a 4/15, 10/15 deadline, similar to the individual, because that's really the level on which the tax is paid. So they're going to have that the 15th day, the 4th month, that runs through to October 15th for a calendar year corporation that has a 6-month extension. The one thing to just point out is that for a June 30th year-end corporation, that actually is pushed off about 10 years when that all starts. So for now, they're still on that 2.5 month and then a 6-month extension. As I mentioned, the partnership return, that's going to move up a month, so that's going to be due on the 15th day, the 3rd month after the close of the year. It'll be easy to remember that in March once these new laws or these new deadlines start coming in. But something to consider, short year partnership returns, something you often don't think about. You're going to have to get that going a little bit quicker, or at least get that extension in a month earlier than you might otherwise have to. And then something I know our trust and estate group was very happy to see was kind of that extra 15 days, the 5.5 month extension now for the trust, because you got plenty of trusts where there's a pass-through coming up to a trust, and then the trust is going up to the individual, and they'll now have, after all those pass-through entities are done, another 15 days to clean all that up, which is good. Additionally, the tax-exempt organizations, they removed the second extension, so now that first extension is going to run you through for a calendar year all the way from 5/15 to 11/15, and the employee benefit plan, 5,500 extension is now 6 months instead of 5. All right, there were some other smaller changes in that highway funding bill. Mortgage reporting is soon now going to include a date, a loan origination date, the principal balance, which will be good for those limitations, and the address of the property. Now going to be a 6-year statute of limitation period for the overstatement of basis. We actually, I had a client who was sort of caught up in this case, and something was opened up. And based on the ruling of this case, which was originally you can't go back to 6-year statute for a basis issue that may have been resulted in an overstatement of income or an understatement of income. But now it can be. It's the same as the income itself. If you have a basis overstatement, which results in an omission of income 25% or greater, you're going to be able to go back that 6 years. Basis conformity for estate purposes, right? Now you're going to need to put out a statement of items passed on to the beneficiaries, who received them, and what the basis of those items were. This way, when they file their tax return, that's the basis that's going to have to show up on that Schedule D. Whether or not they'll be matching it, on an underreporter kind of form, I'm not sure, but you'll probably expect it to get there at some point. And, there'll be a 20% accuracy penalty assessed if you don't match up, right? And so then let's see, what else do we have here? Right, and then there were the Trade Act provisions over the summer. A couple of these were on some lesser used sort of credits, but a couple interesting things were the requirement for taxpayers to receive Form 1098-T to receive the credits and the tuition and fees deductions for tuition, which is certainly interesting because I have plenty of people who, they'll have additional books, they'll have things where, we weren't always matching that 1098-T number. And a lot of times that will result in underreporter correspondence, but it could still be worth it at times. And the other thing is how you're going to pay for all these things, and we're all getting accustomed to this, is the increase in penalties. And in this case, it was the increase in the information return penalties. And so this kind of gives you an idea of where those those penalties have gone to. And the biggest culprit here is going to be the 1099s, right? You're going to want to harp on your clients to make sure those 1099s, that you get everything you need in January if you're helping them with them, or they get them filed and out to the recipients by January, and then if they're e-filing into the IRS in those next 2 months. Right, and then something that came through very recently was the announced partnership audit changes. Right, so we're going to have a regime that replaces TEFRA, where now they're going to be auditing these, and this is really geared towards these larger partnerships because I don't have it here on the slide, but there is an election to opt out if your partnership has less than 100 partners. So for most of the partnerships we're probably looking at, this won't necessarily affect them. However, these big PTPs and master limited partnerships, which have come into vogue at this point, that's really a lot of the reasons these larger partnerships, why they were focusing on it, because it was just creating nightmares as far as how they cost effectively audit. So now they're going to be able to make item adjustments and assess tax at the partnership level, which could just be done at the highest tax rate, right? It also adds a penalty for inconsistent treatment of partnership items if they're not disclosed. We already have that disclosure form 8082, which which you have to use every now and then, so you got to be certain to stay on top of that. And also, right, there's going to be a lot of attorneys called up to rewrite partnership agreements if we're all on our game. Hopefully, because what this really does also, and it requires the partnership to designate a representative with authority to act on behalf of the partnership with respect to these new code sections. So something to think about and consider. Right, and just a small little item to throw out there, FATCA compliance, right? The IRS announced recently that it has now begun to exchange its information with foreign countries as far as what it has on foreign nationals for U.S. banks, right? And just to keep in mind, I don't know anybody who's maybe you're working at a foreign financial institution, or you have clients that are deemed to be foreign financial institutions, right? There's two type of IGAs out there. The Model 1 IGA, where sort of like the Cayman Islands, like the UK were, where the information is collected by the foreign government and then submitted over. And I know we went through that process with clients of actually getting them registered with those online accounts, submitting all the information, or a Model 2 IGA, which the financial institution is responsible for sending the information under FATCA that needs to be sent directly to the IRS using Form 8966. The first year of reporting is limited, but it's gonna kick in and raise up until basically you're almost giving them a 1099-B. At some point that's what it's going to look like, all the information that has to go over. In the first year it was just general information, but it'll get to that point. Right, and what are the consequences? If you're doing returns for any U.S. expats or any foreign individuals in the U.S., you have to remember, they have to be on top of this. It was always my hope that at some point the foreign banks would send out the equivalent of a 1099 to anybody who had information sent over to FATCA. But really, there's been such a growing frustration about the compliance burden and the cost burden by the foreign banks. Many of them have just basically told U.S. persons that they're not welcome at the bank, and so I doubt very seriously that there's going to be anything given to your clients. So they need to be on top of it, or else at some point, I don't think starting with 2015, but at some point they're going to be matching this information, and you're going to get notices. All right, so we've hit our second poll question. Hope I haven't put everybody asleep efficiently or sufficiently yet, and they're able to click on this question. We can move forward once everybody's gotten in. All right, we're getting close to the end here, so hopefully we'll get those last few responses in the next 5 seconds, and I will close it shortly. All right. Looks like most everybody did take advantage of that web pass, so that's good. All right, now we're at the Affordable Care Act. I know we've only got about 10 minutes here, and most of the most of what I've done and seen on this is at least an hour, up to 4 hours. So I'm going to try and hit some of the really salient points and what's coming through now, and what you got to be aware of in the next couple months while we still have some time here. Here are a few of the issues I'm going to cover. Right, the individual mandate, the new excise tax on some HRAs, the player pay, and the 1094, 1095s. Right, so we'll get to that. Okay, here's a little chart for the individual mandate and where it's going to go, where it's going this year, and where it's going to be in 16, right? And it was kind of a nuisance for a lot of people on the 14 return, but anybody who hasn't obtained health insurance yet, it's going to feel like more than a nuisance now when you're talking about, the greater of 2% or $325 a month. I had some clients who still refused to get medical, even though I warned them about this, and if they never went to the doctor, they probably would have ended up in the same place if they had gotten the premium. So there are limited religious exemptions, but this is pretty much gonna be there for everybody. And then something that gained a lot of steam, and I don't think anybody realized originally, that came up in May, June of this year, was this excise tax on certain HRAs, right? So what would frequently happen is businesses would reimburse their employees pre-tax for insurance that they were able to obtain elsewhere, and this was fine. However, the ACA changed all this. This is now, as you can see in that middle bullet there, a $100 per day excise tax for any health reimbursement arrangement that allows you to basically give a pre-tax benefit to an employee. There were some small employers that were given until July 1st to make this change, but really for any large employers, this started with January 1st, 2015. They did carve out 2% shareholders here. That can still be reimbursed and then added on to the wages and taken on their individual returns, right? And so if you weren't aware of this, if now you're stuck possibly with this problem, how do you fix this? Well, you really have until the end of the year to sit down with your clients, or if you're in private, to sit down with an employee and say, hey, listen, this is what was going on. The reimbursements, they've got to go through payroll. There's got to be an adjustment made, whether you go back and amend returns or submit a bonus payment now that goes through a payroll return. Making that a taxable part of their wages, that's really the only way at this point to fix some of those reimbursements and to avoid this $100 a day HRA. And then obviously if you have a written health reimbursement arrangement policy, which you should, however many businesses don't, especially small businesses, it's got to be updated to reflect this and to specifically prevent this. Okay, so what are some of the terms, and a lot of these you're hopefully familiar with by now. What's an applicable large employer? Right now it's an employer that has 50 or more full-time employees, including full-time equivalents, right? Full-time employees, 30 hours a week or 130 hours a month. A full-time equivalent, part-time or seasonal with less than 30 hours a week or 120 hours per month. We're going to take all those part-times and add them up to get to those numbers, right? So we're going to take all the hours of those part-time employees and try to reach these full-time equivalent numbers to determine whether we meet the 50-employee test. Right, affordable coverage. Employer's lowest cost plan cannot exceed 9.5% of household income. Well, the common question is, how do we know what their household income is, right? And there are safe harbors provided, right? And the three are, is it 9.5% of the poverty level? Is it 9.5% of their W-2? And probably the easiest one, because there are often adjustments on the W-2 at year end, 9.5% of their rate of pay. So their monthly, biweekly, weekly rate of pay, if you're at 9.5% of that number, you're good. And what's minimum value? That's going to be 60% of the actuarial value is provided by the plan, and that's in line with the exchanges consider their bronze offering. Right, and here's a quick chart again about when these penalties, when you're going to have some type of penalty applied. There are two of them, which we'll mention. And so, did you have 100 full-time equivalent employees? Right, that phased in earlier. Now we're at that 50 full-time equivalent threshold. Do you offer minimum essential coverage to at least 70%? That was another phased in, right? It was 100 full-time equivalents and 70%, and now the full laws is in effect where your coverage, your minimum essential coverage has to go to at least 95% of full-time employees. And that's an all or nothing thing, right? If you don't meet that number, that 95% number, the minimum essential penalty, which we'll discuss, that's gonna get tacked on for all your full-time employees. The plan provides less than 60% minimum value, and then the lowest cost self-only coverage is more than 9.5 of the safe harbor items. When that's the case, the penalty will apply. However, right, those penalties are based on whether or not you actually have an employee go to the exchange and receive a credit because they did not get affordable coverage. So if you have an employer who doesn't meet these minimum coverage requirements of the 9.5% and the 60% minimum value, right, the IRS is not really going to find out unless that employee goes to the exchange and receives a credit. So there's potentially a way for you not to end up getting penalized, but certainly I wouldn't advise going that route. Right, and what are the penalties we're dealing with? The first penalty, assess when there's a failure to offer coverage to now 95% of full-time employees, right? And that's going to be $2,000 per full-time employee annually, minus the first 30 employees. So there are instances where you may be over that 50 threshold in full-time equivalents. However, if you don't have more than 30 full-time employees, you're not really going to be subject to these penalties because the first 30 are going to come off before you start to get penalized. And then the second penalty, when you don't reach that minimum value, or you're going to get $3,000 per employee that goes and tries to receive a subsidy through the exchange and tries to get that credit when it's not affordable. Right, and so now we have our big reporting forms, the 1094s and 1095s. It's due to the individual on January 31st. It's right along those 1099 filing deadlines. And you have two sets of forms now that employers or insurance companies are going to have to worry about, the 1094B and 1095B, which are going to be done by the insurance carriers or the self-insured employers, and they're going to have a little bit more basic information, just the employer carrier info, the basic info, and the covered individuals. And then you're going to have the 1094C and 1095C, which is going to be for all the applicable large employers, and they're going to be sent out, and they're going to include a little bit more information. They're going to have the month-by-month coverage information, the employee's share of lowest cost premium, as well as the safe harbor that you use to determine that amount was, in fact, minimum affordable coverage or affordable coverage for the employee. And I've had a couple discussions with our group about this, and what do you need to make sure your clients know? They got to find out if they need to file or not. And a lot of the problems now is the HR groups, the ADP, Paychecks, those guys who have really tried to fill this void of how this compliance work is going to get done. A lot of them are not taking new clients. They're not onboarding any new businesses for this. So it may be too late to get involved with that. And if this is something that's going to be on you as a CPA or as a CFO or somebody working at the company to gather this information, it's going to be a lot of man hours. So getting working now is probably what you need to do. And then you got to determine, like I said, who's going to do this work, because because it's going to be a lot of work. And then one thing, for the CPAs working in public out there, the one thing to know is, you're not going to be able to file a return for anyone until they receive their 1094 or 1094B, 1095B or 1095C, right? Because if it's a paper return, that's got to be attached. If not, there's going to be information that has to match exactly. That's going to go on that, go on your return from that form. So it's not like last year where only everybody on the exchange got it and you didn't necessarily have to wait for it for everybody else. You just took their word for it and checked the box that they were covered. This year, you're going to have to wait for that form because everybody who has coverage should be getting one. So unless you're going to leave that box blank and pay the penalty for the full year, you're going to have to wait for the form. And then the one thing here to mention, the Cadillac Tax that's coming into effect. That's going to be a 40% excise tax on the total health insurance premiums that exceed these adjusted numbers starting in 2018, right? And the problem here is that these numbers were set a long time ago, and the cost of health insurance has dramatically risen far ahead of the rising cost of inflation. So what we have here is, you may look at your plan now, $27,500. That's both the employer and the employee side. It's conceivable that there are many plans that are already at that level now. I know that or will be there by 2018. So just something to keep in mind and think about here. And that's it really. There's my information. I know we're already kind of at the end, and I didn't see any questions that came through other than asking about the slides, and I know they did say they would be available for download afterwards. So you should have that. Here's my information. If anybody has questions or concerns, they should feel free to reach out for me, and I'm happy to follow up with them. So thank you.